Assalamualaikum and a very good day to our financial management lecturer, Dr. Rikina Harakis. I am Ruza Zakir Alisha. Before I begin with my further presentation, I would like to introduce you with my group members, the one that will be seeing in the rest of the video, which is Nur Shaira, Nur Afrina, and Wan Ismahanin. We, as a team, will be presenting on our financial ratios for the company Sime Darby Plantation in 2017 to 2021. For your information, Sime Darby is a well-known company in Malaysia, as if people say the word Sime Darby majority, citizens imagine the Sime Darby plantations. Sime Plantations, with a production of 2.097 million, is a founding member of the Roundtable on Sustainable Palm Oil and the world's largest producer of certified sustainable palm oil (CSPO). They are actively involved in ensuring that their 241 farms and 70 palm oil millions in Malaysia, Papua New Guinea, Indonesia, and the Solomon Islands focus on producing outcomes through operational excellence. Before we jump straight into the ratio, to understand this more clearly, financial ratios are a tool to measure a company's performance year by year. All the information is gathered from financial ratio analysis to help managers to make financial decisions for the business and for the external parties like investors. Each of the ratio can be compared to past time periods of the data. In short, financial ratios are very important in business to know whether the business is growing or facing losses.
Firstly is current ratio, which measure company's ability to pay off its current liabilities, those due within a year, with its total current assets and current liabilities. How do we calculate the current ratio? The current ratio can be calculated by dividing current assets with the current liabilities. It shows that Sime Darby current ratio is increased about 6.42% in 2018, which is 1.16 from 1.0909 in 2017. It's decreasing in 2019 and 1.04 maintained until the next year. In 2021, it's rise to 1.04. They increased their inventories and they got a slightly higher ratio compared to 2017. Decreasing in their current assets and increasing in their liabilities make their ratios go lower in 2019. For the year 2019 and 2020, Sime Darby hit the worst current ratio for the 2 years at 1.04. We can assume that both year is struggle year for any company because of the COVID-19 impact the economic position. During of this year, the resources of the business concerned cannot be properly utilized and no sufficient funds to pay off its liabilities in time. Recently, for the year 2021, has a good reputation for current ratio among of these 5 years, which is 1.04. This is due to Sime Darby Plantations had taken steps to improve the ratio, increase liquidity and raise the business standing in the eyes of lenders, investors and other stakeholders. Overall, Sime Darby Plantations current ratio is at good position. Secondly, quick ratio, which measures the ability of a business to pay its bills. A quick ratio of 1 month or above indicate that a corporation is likely to be able to meet its short-term obligations without relying on inventories. The quick ratio is calculated by deducting current assets with inventory and prepaid and divide with current liabilities, which is based on the most liquid assets and liabilities on a company's balance sheet. It shows that the ratio was highest in 2017, which is 0.70. It indicates high ability to meet short-term obligations as they come due. The downtrend analysis was seen since 2019 to 2020, which is they share the same amount 0.62 for their quick ratio and can be concluded the Sime Darby Plantation like struggle with paying debts. This is a bad sign for investors and partners. However, this ratio is unacceptable because less than 1. Sime Darby Plantation may not be able to fully pay off its current liabilities in the short term. The ideal standard quick ratio is mean that the company is not in a position to meet its immediate current liabilities. It may lead to technical solvency. Lastly is net working capital. It's used to measure company ability to pay off current creditors with current assets. It's measured by net working capital, which is liquidity metrics. This metric is significant to management, vendors and general creditors since it demonstrates the firm's short-term liquidity and management capacity to effectively employ its assets. Net working capital can be calculated by dividing current assets with current liabilities. Same goes to our previous ratios, which is current assets. A good rule of thumb is that a net working capital ratio of 1.5 to 2.0 is considered optimal and shows the business is better able to pay off its current liabilities. From the above calculated data, we can see that Sime Darby Plantation's net working capital is weak for 5 years. In 2017, the ratio is 1.9 and increased to 1.16 in 2018 due the company has improved their current assets to cover their current liabilities. Next, in 2019 and 2020, the ratio is constant at 1.04. We can infer that these both years is struggle year cause of pandemic. Amazingly, the ratio increased after 2 years is start, which is at 1.24. It appears the firm is better positioned to take advantage of new business opportunities. Sime Darby Plantation may take corrective actions by increased inventory turnover and limit slow-moving inventory or offer incentive to clients if they pay in shorter periods.
Hi, Assalamualaikum. My name is Nur Shaira and I will explain about leverage ratio. As is stated, leverage ratio are used to determine the relative degree of debt a company has accumulated. This ratio compare a company's total debt commitment to its asset or equity. A high debt to cash flow ratio shows that a company has taken on more debt than it can fairly service with current cash flow. Okay, first we are moved to debt ratio. Okay, the debt ratio is a financial ratio that determines how much debt a company has. The ratio of total debt to total assets represented as a decimal or percentage is known as debt to asset ratio. It refers to the percentage of a company assets that are financed through debt. As previously stated, the debt ratio is critical in determining the amount of leverage a company has in terms of total debt to total assets. It is also varies significantly by industry, with capital-intensive enterprise like utilities and pipelines having far greater debt ratio than others industry like technology or service. Okay, this is the review from Sime Darby Plantation for the past 5 year statement of financial position and statement of profit or loss as we are able to produce this showed data this showed table here based on the recorded data stated. Sime Darby Plantation clearly show fluctuating trends in the past 5 years. Um, Annual reports. The highest debt ratio was recorded in the year 2019, which is 0.35, which also was the highest total debt with RM 10,139 million for the past 5 years. A ratio greater than 1 indicated that assets are used to fund a significant share of the debt. In the other words, the company has more obligation than asset, and a high ratio suggests that the corporation is at risk of defaulting on its loans if interest rates unexpectedly rise. When the ratio is less than 1, it means the equity funds a larger percentage of a company asset. Alright, to summarize, Side Darby Plantation has performed admirably in terms of keeping its debt ratio in line with its overall amount equity over the last 5 years. Okay, next we are moving to the debt to equity. So the debt to equity, as we can call DE, ratio is computed by diving a company total liabilities by its shareholder equity to determine its financial leverage. The debt to equity ratio is a key measure that shows how much a firm relies on debt to support its operation rather than wholly owned capital. Um, In the event of a business downturn, it indicates the ability of shareholder equity to cover all outstanding debt. From a survey of the Sunderby Beyond's long-term statement of financial position and for explanation of profit or loss, we can create a, compa- a, com- accompanying table as you can see it here. Okay. According to the data, the greatest debt to the equity ratio was recorded in 2017. This is due to a large number of liabilities and equity, which put the company shareholder in danger. However, there is a tiny upward trend during the next year, indicating that the remarks recorded in 2017 were given due consideration. Okay, the debt to equity ratio compare a company debt to its net asset and is commonly used to determine how much debt a company should take on the leverage its assets. A high a high debt to equity ratio is typically associated with high risk since it implies that a company has borrowed money to expand. Subsequently, Sandarbi Group has thought about issue based on the high debt to equity proportion to guarantee the investor trust. Okay, the information for 2000 for the information for 2019 showed the second highest debt to equity ratio, which is 0.74. Um, the Darby should make the important move according to the years explained previously. However, as the table show a slightly decline to 0.65 in 2020 in 2020 and has increased in 2021, resulting in the lowest debt to equity compared to 2017, 2018, 2019, and 2020. This indicates a lower amount of financing by debt via lenders versus funding through equity via shareholders. This is also due to the lowest total debt amounted Rm 8,637 million in 2021 compared to previous year, which lead to a more stable company longevity potential. Alright, next we are going to the time interest earned, which is interest coverage ratio. So the time interest earned, we also call TIE, ratio is a measure of a company's ability to meet its debt obligation based on its current income. Okay, the formula of a company tie number is earning before interest and taxes EBIT divided by the total interest payable on bonds and other debt. Therefore, the importance of time interest earned for an organization is to identify and indicate its ability to pay its debt with better time interest earned record showing the stability of an organization after after paying its debt. From a review of the Sime Darby's past 5-year statement of financial position and statement of profit or loss, we are able to produce the table show. In the past 5 years, Sime Darby, um, Sime Darby highest time interest earned is 43.34, which was recorded in year 2021. The group best performance showed a staggering increase in time interest earned throughout the 5 years and indicates an 842 842.17% increase from the year 2017. This is due to 2021 remarks the highest earning before interest and taxes amount compared to the other 4 years, result in the highest time interest earned. Time interest Time interest earned ratio measure a company ability to continue to service its debt. It is it is an indicator to tell if a company is running into financial trouble. In 2021, they mark a high ratio means that a company is able to meet its interest obligation because earnings are significantly greater than annual interest obligation. However, a high ratio can also mean that a company has a undesirably low level of leverage or pay down too much debt with earning that could be used for other investment opportunity to get a higher rate of returns. Hence, this concludes that the group of time interest earned is at par and showing increasing trends throughout the 5 years. Okay, lastly, I will going to explain about the equity ratio. The equity ratio is a financial indicator that determines how much debt a company is using. It determines how successfully a firm manages its debt and funds its asset requirement by looking at asset, investment, and equity. If a large amount of debt is used to fund growth, a company may be able to create more earning than it would otherwise. Shareholders can expect to benefit if leverage boosts earning by more than that cost, which is interest. Uh, sh- Share values may fall if the cost of debt financing outweigh the improved income provided. Based on the data, Darby record on the equity ratio showed the company has an equity ratio below zero point 0.5 for 4 years, include 2017, 2018, 2019, and 2020. Okay, that's mean in those 4 years the company has high leverage. They have taken on more debt to finance their business, which mean it is not run quite as conservatively and will be viewed as riskier. Although they have made more profit, they may not be as solvent in their operation since they have taken on more debt relative to their equity. However, in 2021, Sime Darby has increased to 0.51 their equity ratio compared with previous year. The owner of the company are seen as running their business conservatively because they only taken on RM 14,719 millions of debt relative to the RM 15,827 million they own. They are likely a solvent company that doesn't represent a great deal of financial risk. Okay, any company with a equity ratio value that is 0.50 or below is considered a leveraged company. The higher the value, the less leverage the company is. Conversely, a company with an equity ratio value that is 0.50 or above is considered conservative company because they access more funding from shareholder equity than they do from debt. A high ratio value also shows that a company is all around stronger financially enjoys a greater long-term position of solvency than company with lower ratio.
Next, profitability ratio. Profitability ratio are a class of financial metrics that are used to assess a business' ability to generate earning relative to its revenue, operating costs, balance sheets, or shareholders' equity over time, using data from a specific point in time. So, we will discuss about net profit margin, operating profit margin, gross profit margin, return on assets, and return on equity.
So now first we'll talk about operating profit margin. So as we can see, the decline in operating profit margin from 14.61% in 2017 to 4.15 in 2019 appears to be the result of Sime Darby's company operating leverage. So, the OPM seems to sharply increase from 4.15% in 2019 to 20% in 2021. And like the growth of OPM indicates that the firm is earning enough money from business operation to pay for all of the associate costs involving in maintaining that business. Like for example, if the ratio is calculated to be 20%, that means for every ringgit of revenue generated, uh, 0.20 cent is retained, while 80 cent is attributed to the cost of goods sold.
Next, profit margin. The first one is a net profit margin. Net profit margin measures how much net income is generated as a percentage of revenues received. Net profit margin helps investors assess if a company's management is generating enough profit from its sales and whether operating costs and overhead costs are being contained. How to calculate the ratio? The formula for net profit margin is earning after tax divided by total revenue and multiplied by 100. The graph shows that 2017 is the highest net profit margin. A higher profit margin is always desirable since it means the company generates more profits from its sales. In 2018 and 2019, the net profit margin dropped drastically. A declining profit margin means that the firm is making less money per dollar of sales. This can be the result of a lower sales price of higher costs if total sales fail to increase to make up for such a decline. Total gross profit in the income statement will go down. Then, in 2020, it improved, but not to 2017 levels. Despite having the highest revenue collection since 2017, the net profit margin increased in 2021 by 42.17%. The ratio shows how well the company can achieve its goals of optimizing the group's treasury and attracting new capital. Gross profit margin. The gross profit margin is a metric used to assess a firm's financial health and is equal to the revenue less the cost of goods sold as a percent of total revenue. The formula for gross profit margin is gross profit or gross income divided by total revenue and multiply by 100. After we calculate the formula for the gross profit margin, the gross profit margin shows fluctuating changes over the 5 years of the survey. The highest gross profit margin is in 2018, which is 32.32%. The higher the margin, the more effective the company's management is in generating revenue for each dollar of cost. The margins show a decline in 2019 and 2020 and a continued increase in 2021. Despite total revenue reaching a new high in 2019, the gross margin fell by 17.23% in 2019. According to reports, the group was having trouble dealing with suppliers who were raising costs, resulting in a 34.69% decrease in the margin in 2020. Return on assets. Next, the term return on assets refers to a financial ratio that indicates how profitable a company is in relation to its total assets. Furthermore, the formula for return on asset is earning after tax divided by total assets and multiplied by 100. After we calculate the formula for the return on assets, in 2017, the group hit the highest return on asset margin at 11.91%. In general, the higher the return on assets, the more efficient the company is at generating profits. However, anyone's company return on assets must be considered in the context of its competitor in the same industry and sector. Then, the value of return on asset fell sharply in the next year to 91.18% and continued to decline in 2019 to 59.04%. The company seems to be facing major strategic management by expanding too quickly. Therefore, Sime Darby has taken into consideration to increase the net income and improve efficiency on current assets and fixed assets in 2020 and 2021, resulting in the return on asset margin climbing 809% in 2020 and continue to increase 89.67% in 2021. Return on equity measures the return earned on the common stockholders' investment in the company. The formula for return on equity is earning after tax divided by total equity and multiplied by 100. In 2017, the group's return on equity margin was the highest in 5 years. In 2018, margins fell rapidly by 91.84%, and this trend continued in 2019 with margins falling to 59.46%. The company's diminishing return on equity shows that it is becoming less effective at generating profits and creating shareholders' value. However, the margin continued to grow at 778% in 2020 and quickly increased at 82.55% in 2021. The table displays the trend analysis since 2017, which should be enough to persuade investors to fund the company if asset management, leverage, and pricing are all efficient.
Activity ratios are used to assess an organization's efficiency in generating cash and revenue from its assets. It is used to determine the amount of money invested in an asset as well as the revenue it generates. As a result, the activity ratio is often referred to as the efficiency ratio or more commonly the turnover ratio. The activity ratio, also known as the turnover ratio, is used to assess a company's efficiency by examining inventory, fixed assets, and account receivables. Inventory turnover It is a measure of how many times a company's inventory has been sold and replaced in a given period. A low ratio indicates poor sales and maybe surplus inventory, whereas a high ratio indicates good sale or insufficient inventory. The speed with which a company can sell its inventory is a key sign of its success. Companies that move inventory out more quickly outperform slower companies. The higher the holding cost of an object, the longer it is kept. The formula is cost of goods sold divided by inventory. Average collection period, also known as day sale outstanding, in terms of account receivable, ACP is the time it takes for a firm to collect money owing by its client. It is used by business to ensure that they have enough cash and on hand to meet their financial obligations. A greater ratio may suggest that the company is having trouble collecting debts. A smaller percentage indicates that the company is able to collect its obligations on time and thus has more liquidity. However, this could indicate that the company's credit terms are excessively severe, leading to clients looking for suppliers or service providers who provide more flexible payment terms. The ratio in Malaysia is calculated over a 360-day period. The formula used for average collection period is account receivable balance divided by revenue for 12 months multiplied by 360. Total asset turnover, also known as asset turnover, it is a number of sales generated per ringgit invested in the firm asset. As a result, the ratio is a metric for how successfully a company's assets are handled. A greater ratio indicates how effective a company's overall assets are at generating sales. The formula used for total asset turnover is sales or revenue divided by total asset. So let's see here, inventory turnover. In 2019, Sam Darby had managed its ITO more effectively as compared to the previous year that increased 1 to 2%. The reason for this is due to the concert efforts by the Sam Darby. This is because they reduce the holding of inventory age more than 180 days through a combination of innovative sales strategy and careful inventory management. So this has led to inventory levels for the company declining to RM 1687 million in 2019 compared to RM 1861 million in 2018. Between 2021 to 2017, the company averaged an ITO of 5.11. The only year the company fell below the ITO average was in 2018. An analysis of 2018 shows that despite 2018 having the lowest COGS value of RM 4409 million against an average of RM 9972.6 million for 2017, 18, 19, 20, and 21, 2018 are the second highest inventory value of RM 1861 million after 2021, which amounted RM 2749 million as compared to the 3-year 2020, 19 and 17 average for RM 1734 million. So the second one is average collection period, known as day sale outstanding. So in the past 5 years, Sam Darby average ACP is 74 days. The company best performance was in 2021 with an ACP of 55 days. This marks a reduction of 25.6 57% against the SCP average of 74 days. This performance was due to the company achieving its highest revenue of Rm 18,695 million in the past 5 years. Sam Darby also had its worst, average collection period in 2018. This was a tribute to a poor revenue value of Rm 6514 million, which is the lowest revenue generated compared to 2017, 19, 20, and 21. So let's look at the total asset turnover. So from the calculation, we saw that the asset turnover ratio of Sam Darby is lesser than 1 from 2017 to 2021. So this means that the total asset cannot produce enough revenue at the end of the year. But that doesn't mean it is a lower ratio. Sam Darby for 2018 has the lowest asset turnover of 0.23. This is driven by the denominator of asset that includes huge numbers such as plant property, equipment, and goodwill, and also lower revenue. Sam Darby didn't manage its asset more efficiently in the past 5 years, which is 2017 to 2021. This means that the company started in not very efficient with its use of asset. So this resulted lower total asset turnover for the past 5 years. So Sam Darby have a lower ratio, which may be due to poor utilization of its asset, poor collection methods, or poor inventory management. However, if we compare the past 2 years between 2018 and 2021, total asset turnover in 2021, Sam Darby achieved a total of 0.61. This is a 160.87% increase compared to 2018 total of 0.23. The main reason for the higher total in 2021 is because of the higher total revenue by year end as compared to 2018, which is Rm 18,695 million versus Rm 6514 million.
In conclusion, Sam Darby also faced a lot of challenges. Sam Darby Plantation Berhad, for example, will be aiming to study a extent opportunities to build its essence in other significant topographical market in Southeast Asia, the United States, Europe, Africa, and the Middle East, which will make a big impression on Bursa Malaysia. Identity with increased protectionism and changeable assessment, taxes, and collection in trade marketplace are the main issues that palm oil players are concerned about. This is because of its importance in various developing and developing nations, as well as its ability to switch deal contribution between fall and refined items. Confirmed practical palm oil (CSPO) versus isolated CSPO, which allow it to hedge against any potential effects on incomes, according to the report.